Why does a jobs report move mortgage rates so much? I mean, that's a question of the week. Really, we've got jobs report and unemployment on Friday. But before that, this particular week that's ending July is stacked with data. I mean, we have GDP for second quarter, we have PCE, we have the JOLTS report, initial jobless claims, all of this including consumer confidence leading up to the finale. The finale is the jobs report. And I want to talk about it because why is it so important? Like, why does this one report released once a month move mortgage rates so much? And ultimately, it's because this one report isn't just about jobs. It's called jobs report, but this one report is about inflation. It's about recession risk, and it's about the Fed's next move. It tells a story about the economy. So I want to share why the jobs report matters so much to you, especially if you're thinking about buying a home or really at any point, because ultimately it happens every month. What even is the jobs report? Because if you're not knee deep in the economy or the economics of it all, you might not even realize what's happening. And ultimately, the first Friday, outside of being a fantastic time to visit the arts district, is also when the jobs report comes out. So it might be the time that if you are looking to buy a home or even refinance, you might want to know where that sits in your process. The jobs report is officially called the non-farm payroll report, or the NFP. It's released every single month by the Bureau of Labor Statistics, the BLS. It reports the total number of jobs added or lost, how many people are unemployed, and what are people earning. And it's used by economists nationwide. It's used by Wall Street and by investors. And it's used by the Fed to gauge economic strength. So why does the jobs report, this one report, impact mortgage rates so much? Because if I were to line up all of the economic reports that we get out every single day throughout the month, this is the one that acts as the health check on the economy. It affects how investors feel about long-term inflation and then long-term interest rates. So if I look at the job number, if I see strong job growth, that's telling me that we have an underlying strong economy. And that is a potential for higher inflation, higher spending, higher cost of goods, higher inflation. I'm going to require higher interest rates. Weak job growth means I might be looking at a recession risk or a slowing economy. There's a potential there for rate cuts, especially as the Fed might want to move in and kick up the economy a little bit by dropping the short-term rates and increasing the opportunity for spending. So the bond markets react instantly. And then our 10-year treasury moves accordingly, and our long-term mortgage rates follow the 10-year treasury. So ultimately, good news for jobs is often bad news for rates, and vice versa. So Wall Street and the Fed obsess over the jobs report because they're watching to see if too many jobs are being added and wages inside the jobs report are rising too fast, then the Fed is going to back off and worry that inflation is going to rise again. In those cases, they're going to keep the Fed rate higher for longer. The Fed, remember, has two jobs. That's it. I often joke with my husband, Pepe, his real name is Peter, that he has one job and he can't keep the one job straight. I'm questioning whether or not the Fed can keep their two jobs straight right now. And they only have two. It's a dual mandate for low inflation and strong employment. So when we see a strong jobs number, it's like adding fuel to the fire. Too much growth, rate hikes are going to stay around for longer. If job growth slows down, it will signal that the economy is cooling. And that's when rates can come down. This is a balancing act that the Fed has to manage. And the jobs report tips the scale. If you're looking to purchase a home, really at any time, because remember this happens the first Friday of every month, or if you're looking to refinance, then being aware of what's happening and what the data that's leading up to the jobs report, and then ultimately the jobs report is when it's happening. Because a strong jobs report can send rates up 0.25%. Easily it could move within that, and sometimes on a really big report that is different than the expectations, it can move the rates even more. So if you're floating your rate or you're looking to take action, timing matters. This is why working with a lender who geeks out over the economics and understands the economic calendar can give you an edge. Based on the predictions and based on all the data leading up to the jobs report, you might determine that your best move is to float through it, to gamble, to maybe lower interest rates on the other side. Or, based on the data leading up to it, your best move might be to lock in. Yes, you might leave a little bit of a lower rate on the table, but you're going to be secured against the fact that we might get a jobs report that might move in the wrong direction. And as a lender, I'm not here to scare anybody. Like, I don't believe in pressure sales, ever. Lead with education first. I'm just here to give you the tools to act with the best information that you have at the time. Rates are influenced by data, especially when they miss the mark on the predictions leading up to the data. And understanding that gives you a little bit of control back. That's why we track the market for you, not just do mortgage lending. So ultimately, to answer the question, do jobs reports move mortgage rates? Absolutely. The answer is yes. Sometimes fast and sometimes very little. But understanding the why behind it gives you the power to make smart, confident decisions. If you're thinking about buying or you just want to talk strategy, please reach out to me. I love these conversations. DM me and drop your questions down in the comments and share this with someone who's sitting on the sidelines waiting and unsure given today's lack of clarity. I'm Nicole, Rueth, reminding you, real estate isn't about timing the market. It's about building wealth right through it. I get to see you next week.